I talked about the importance of having an equity bias. Well, these are some of Roger Ibbotson's data. He's got this publication called Stocks, Bonds, Bills, and Inflation. And the basic drill was, starting in 1925, looking at a number of asset classes. The ones that I've got here are Treasury bills, Treasury bonds, large stocks, small stocks, and then as a benchmark, inflation. Starting the investment at the end of 1925, taking whatever income was generated from that investment, reinvesting it, and seeing where you end up at the end of the period. And what I've got here are the numbers from 1925 to 2009. And if you did that with Treasury bills, which are short-term loans to the US government, one of the least risky assets imaginable, you would have ended up with 21 times your money over the period. You think about that, 21 times your money, that's pretty good. But if you think about the fact that inflation consumed a multiple of 12, well, 21 times, but taking off 12 times for inflation, not so good. And instead of looking at Treasury bills, you look at Treasury bonds, you end up with a multiple of 86 times. That's pretty good, 86 times. It's a lot better than whatever, 21 times for bills. It's still not a huge return for decades and decades of investing. So what happens if you move away from lending money, and in this case lending money to the government, to owning equities? The multiple over this period, and this includes the crash in 1929, the market collapse in 1987, and the most recent financial crisis. In spite of those blips, you would have ended up with 2,592 times your money. That's stunning. That's like way more than 86 times and way more than 21 times. So over long periods of time, you do end up being rewarded for accepting equity risk. And what would have happened if you would have put the money in small stocks and let her run? 12,226 times your money. So the conclusion is pretty obvious. This notion that if you've got a long time horizon, you want to expose your portfolio to equities makes an enormous amount of sense. As a matter of fact, the first time I took a look at these numbers was back in 1986. I was preparing the lecture that had to do with long-term investment philosophy, and that's when I first saw these numbers, and I was a little bit disconcerted when I put them together, because I thought, gee, 21 times for bills, 86 times for bonds, 12,226 times for small stocks. Maybe the right thing to do is to just put the whole portfolio into small stocks and forget about it. And my first problem was, if that were true, what was I going to say for the next 10 weeks of lectures? And my longer-term problem was, if the investment committee figured out that all we needed to do was put the whole portfolio in small stocks and that was the way to investment success, I wouldn't have a job. They wouldn't need me to do that, and I had a wife and young children, and I like getting a paycheck and being able to feed and house them. So I took a look at the data more carefully, and there are a number of examples of what it is that I'm going to talk about, but the most profound example remains around the Great Crash in 1929. And if you'd had your whole portfolio in small stocks at the peak, by the end of 1929, you would have lost 54% of your money. By the end of 1930, you would have lost 38% of your money. Another 38%, that is. By the end of 1931, you would have lost another 50%. And by June of 1932, for good measure, you would have lost another 32%. So for every dollar that you had at the peak, at the trough, you would have had 10 cents left. And it doesn't matter whether you're an investor with the strongest stomach known to mankind, or you're an institutional investor with the longest investment horizon imaginable, at some point when the dollars are turning into dimes, you're going to say this is a completely ridiculous thing to accept this much risk in the portfolio. I can't stand it. I'm selling all my small stocks and going to buy treasury bonds or treasury bills, right? And that's exactly what people did. And there was this sense in the 1930s, 1940s, even into the 50s and 60s, that heavy equity exposures weren't a responsible thing for a fiduciary. When I was writing my book, I was kind of fooling around looking at articles from the Saturday Evening Post, and there was this article in the 1930s, and the commentator said that it was ridiculous that stocks were called securities, that they were so risky that we should call stocks insecurities. Right? There was just this visceral dislike for the risks that were associated with the stock market because it had caused so many investors so much pain. So yes, stocks are a great thing for investors with long time horizons, but you need to diversify because you've got to be able to live through those inevitable periods where risky assets produce results that are sometimes so bad as to be frightening. Second source of return, market timing. And I found this quote: "The idea of wholesale shifts is for various reasons impracticable and indeed undesirable. Most of those who attempt to sell too late and buy too late and do both too often, incurring heavy expenses and developing too unsettled and speculative a state of mind." And as in most things, the data support Keynes's conclusions. Morningstar did a study of all of the mutual funds in the US domestic equity market, and there were 17 categories of funds. And what they did with this study is they looked at 10 years of returns and compared dollar-weighted returns to time-weighted returns. The time-weighted returns are simply the returns that are generated year in and year out. If you get an offering memorandum or a prospectus, they'll show you the time-weighted return. If you look at the advertisements where Fidelity's touting its latest, greatest funds, the returns that you see are time-weighted returns. Dollar-weighted returns take into account cash flows. Right? So in a dollar-weighted return, if investors put more money into the fund in a particular year, that year's return will have a greater weight in the calculation. So here we have all the mutual funds in the US, 17 categories, time-weighted versus dollar-weighted. In every one of those categories, the dollar-weighted returns were less than the time-weighted returns. What does that mean? That means that investors systematically made perverse decisions as to when to invest and when to disinvest from mutual funds. What investors were doing, they were buying in after a fund had showed strong relative performance and selling after a fund had shown poor relative performance. So they were systematically buying high and selling low. So the conclusion for these individuals that operate in the mutual fund market is that their market timing decisions were systematically perverse. I also took a look at the top 10 internet funds during the tech bubble. This is something I published in my book for individual investors. And if you looked at the top 10 internet funds 3 years before and 3 years after the bubble, the time-weighted return was 1.5% per year. So you look at that and you say 1.5% per year, well, the market went way up and way down, but 1.5% per year, that's not so bad. No harm, no foul. Investors invested $13.7 billion and lost $9.9 billion. So they lost 72% of what they invested. How could it be that they lost 72% of the money that they invested when the time-weighted return was 1.5% per year for 6 years. Well, they weren't invested in the internet funds in 97, and they weren't invested in 98, and they weren't invested in early 99. It was in late 99 and early 2000 that all the money piled in at the very top. And then in 2001 and 2002, bitterly disappointed, they sold. So they lost 72% of what they put in, even though the time-weighted returns were 1.5% per year positive. If you look at the crash in October 1987, which was an extraordinary event, and what happened on October 19th, 1987? Well, stock markets the world around went down by more than 20%. What people forget is, along with the stock markets going down, there was a huge rally in government bonds, flight to safety. So stocks were cheaper, bonds were more expensive. What did institutional investors do? Well, they got scared and they sold stocks and bought bonds. Same thing, buying high, selling low. As a matter of fact, endowments took 6 years to get their post-crash equity allocations back up to where they were before the crash, arguably underweighted in equities in the heart of one of the greatest bull markets of all time. So it seems that investors, whether they're individual or institutional, have this perverse predilection to chasing performance, buying something after it's gone up, selling something after it's gone down, and using market timing to damage portfolio returns.